All right, you are watching Morning Markets on BNN Bloomberg. The markets are under pressure as the inflation boogeyman reared its ugly head, this time in Europe. Jim Thorne, Chief Market Strategist at Wellington-Altus Private Wealth, joins me on the desk. And Jim, for those that watched our Bank of Canada coverage, you were time-stamping your call. Inflation ultimately is going to cool. Central banks are going to cut rates. And in this last month, we have seen a dramatic repricing of that. Now expecting rates are going to go higher as inflation has also been coming in higher. Has your view changed at all?
No, because Jay Powell at Jackson Hole said he's going to look at the totality of the data. And we think that January is an outlier, and we've talked about, seasonal adjustments, population adjustments, one-time price increases that we just don't think are going to filter through to the rest of the year. And, if you look at what happened with the GDP number coming out of Canada, right, we had the GDP deflator was negative. Mm-hmm. Wages have basically been flat to down since August. So in Canada, we don't have an inflation problem. And so my whole position has been I don't think the central bankers are ideologues. I think they're data dependent. And I think there's a lot of people out there that listening to the rhetoric and the communication strategy of some Fed officials, they're ignoring the data. And as the data continues...
The Fed officials, you think, are ignoring the data?
The Fed officials are, yes. So, for example, we had employment cost index came in this morning at 3.2%. That's down from 6.9%. That's a 57% decline in unit labor costs. I don't know. That's a decline in wages, right? So my whole thesis is that eventually, as you're seeing Tiff Macklin up here start to pivot and start talking about pausing, the data will become irrefutable in the United States by the spring. And the question is will Jay Powell push back against the ideologues? And I think he will.
So it's interesting to hear you talk about the areas of inflation that you're watching. And this highlights, a frustration that I have is you can cherry pick the data however you like to pull out the narrative that you want, because I could counter and say, well, look at ISM prices paid. It ticked up again yesterday. So where are you putting the emphasis when you're looking at areas of inflation? Because people will torture it, and I've seen you torture the data. If you strip out food, energy, all this stuff, I can't strip out food and energy, right? So inflation is still real.
So with the ISM data yesterday, I look at the 6-month moving average, and the 6-month moving average is still below 50. And so what I find so interesting, Amanda, today is the fact that, when the ISM comes in at, let's say, 50 is the economy is red hot, right? And so what I do is I look at 3-month data, I look at 6-month, 7-month data, and if you look at that, and that goes back to the Fed, the Fed used at Jackson Hole the declining prices and saying, we're going to ignore it because the totality of the data from the first half of 2022 was inflationary. They can't have it both ways. And if you look at 6-7-month data, eventually that's going to go into, my call is to 12-month data, and there's going to be no argument.
So if you're sticking with your conviction, are you buying the dips in both the U.S. and the Canadian markets?
Yes. And this is exactly like the dip in 2009 between June and July. Amanda, coming off of a bear market low, and it is a bear market low. So why do I say that? Technology outperformed in a down market, and it outperforms in an up market. The leadership has changed, but yet fundamentals don't matter this year. It's all going to be technical. So let's look at the number of stocks above the 200-day moving average. Still very strong. So we should expect these whipsaws. And what we should expect once we get our sea legs and people realize the key data is going to be the employment cost index in April, then what's going to happen is those people that say, I'm going to buy the dip, and we start going up, they're going to basically have to buy and be forced in.
Now, the pushback will be that's the old mentality of there is no alternative, and now there is an alternative, right? The yield that you're getting in the bond market is about to approach on certain bonds and outpace the earnings yield that you get, for example, the S&P 500. So I can go park my money elsewhere in a safer place and get a higher yield just for sitting on cash.
At this point in time, yes. But if you look out, if you feel that we're going to cut and we're going to pause and we're in a secular bull market, then those people will be phoning up their brokers when the market is going to be substantially up, saying, can I get out of my locked-in 2-year GIC at X%? And so this is what makes a market. And so I'm very comfortable with the give and take. What I am trying to suggest is that we're going to go back to the late 90s, where the argument was deflation versus inflation. We called it fire and ice. And it was a big discussion between Barton Biggs and Steve Roach. That's where we're going, because right now, and you're right, if I take CPI and I take out shelter, right, it's negative. So I can point to right now deflationary measures. Now, how, if we go back to school, right, inflation is the year-over-year rise in general prices, not the change in relative prices. There's always going to be an area of the price data set that we're going to be able to point to inflation and deflation. Our point is, and I think Tiff Macklin should be given credit for him to consider a pause, and I think that's exactly what should happen right now. She should pause and let's let the rate hikes work through the economy. And if we don't get a decline in inflation, like I am suggesting, then by all means, raise rates.
What are you doing, and are you allocating money to certain sectors, certain areas to hedge in case you're wrong about this call? You know, so you want to buy the dip, but in case that doesn't work out, is there a way for investors to follow your view but also have some protection in case this view doesn't come?
What we talk about to our clients at Wellington is to high grade your portfolio. So this is your opportunity to buy really solid, high quality names with dividend yields, with strong free cash flows, with defendable business models, and they're on sale. So I would say high quality names. Do
the banks qualify?
Yes, I think the banks.
Because they've not been rewarded at all this earnings season.
This earnings season, but off the low. I mean, off of the October low. This is the point. Like, everybody's freaking out about Tesla today. Tesla's up 89% from the low. Right? And so, look, the Canadian banks are they're the best managed banks in the world. We could argue about valuation because of the home bias in Canada, right? We could argue about the quality of book. We could argue about the quality of their Tier 1 capital, but they're going to be fine. And if you believe that the Fed and the Bank of Canada aren't going to break it, then financials are the place to be.